Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. I'm muted, of course. Okay, so today we got retail sales. So still some pretty big stuff to deal with here. I mean, it's been a news-heavy week, hasn't it? And we've definitely had some twists and turns in the week. And I'm kind of concerned. Well, let's see here. So the retail sales month-over-month reading, last time spot 4%, this time spot 3%. That sounds about right to me, although I do think that there is a slight possibility that we get a spot 2. If we got a spot 2, that would be super interesting. I mean, that would be kind of stagflationary, but I think that the market would probably care about that more than they care about, or they should, at least. I don't know if they will, but I think that that would be more important than the slight bump in inflation that we've seen this past week. So really, really important number. Let's come and look at the charts and just see where we are at. So yesterday, was it yesterday? Yeah, yesterday. Got a decent boost there in the treasuries. Didn't really make sense why the PPI, but apparently what I've been told is that when you look at the components of the PPI and you translate them into the PCE, that PCE is not really affected. And so that's actually really, really good. And that is why they bought and they moved up. As a really crazy trade and a move, there must have been like one big guy out there making that. I don't know, but kind of a little bit of a confusing one for us during the day. But like I said, usually by the end of the day, we do have a good explanation for it. Okay, S&P 500 looking pretty good. Yeah, looking pretty good there, but they are kind of like up on resistance. So we'll see if they can push through. You know, this retail sales is going to be really key to that. Right here is oil. Oil's still kind of doing some back and forth here, hasn't it? Gold and silver, though, looking great. Oh, silver really looking amazing. Ooh, yeah. Let's go. Okay, and then copper. Okay, yeah, copper's kind of following along with them. And the Japanese yen, a little bit of a rise overnight. And the dollar falling to some new weekly lows. And what about Bitcoin? Well, so the interesting development in the Bitcoin world is that GameStop is considering switching itself into a Bitcoin ETF like MicroStrategy has done. Which really says to me, they've had all of this money, they've generated billions of dollars in cash and everything, and they can't think of anything better to do with it than to put it into Bitcoin now. After like what, 4 years? It's been 4 years, and then that's your idea, is put it into Bitcoin. Are you kidding me? I kind of feel like that they have committed fraud over there. But whatever. Okay, so here comes the news. Okay. Core retail sales is negative spot 4. So really kind of the scenario I was talking about. Okay. So I think that this is a good situation, similar to like non-farms last Friday, where it was a similar situation to this, And I kind of felt like I screwed up by taking on too much size right at the very beginning. I am noticing a little bit of a hole there at 03. A little bit of gravity, but it's so soon. I think we should still have some good. There you go. That's looking pretty good. I tell you what, man, if this goes, that spot is going to look so good. But because of the chance of how much it could move and everything, one contract for now. One contract. That way, you know, if it does come back to, like, say, the open, and I don't want to do it, like, just as it hits the open, but maybe I could add a second contract later. Okay. Because I was conservative with my entry. But so far, I was somehow able to pick the pullback almost exactly. I mean, I was definitely seeing it on the DOM here, but the kinds of edges that I'm picking up to find those spots are so tiny, I shouldn't expect to catch it every time. So I'm still going to be really, really pleased if it ends up working out. $9K offer in ZT and it was filled? That's interesting. But especially in that instrument. Okay, so here's a theory. Is a really big order in ZT more likely to be a hedge than in the other instruments? I kind of feel like that particular Uzi says yes. I kind of feel like, while that is a really big order and everything in terms of like what it tells us about the future, I kind of feel like that because it's in CT, it doesn't really tell us a whole lot. But at the same time, the timing of it is really, really curious. Like, why would you quote unquote hedge just after that retail sells, right? Hedge treasuries lower. I don't know if that one makes much sense. Because the thing that I've been kind of seeing and picking up on, and again, this is kind of like more of the one up on Wall Street kind of approach to things, is that I can definitely see people's spending slowing down, and not just because I'm currently out of work. Okay, I'm seeing it across the board when I go out. You know, like I still see a lot of people out shopping, but like, what are they shopping for? How much are they buying? It's slowing down. It's slowing down. And so I think that there is a scenario here, a somewhat likely scenario, where the inflation is in fact not a big deal because the economy is kind of like slowly dipping into a recession. And the question is just, does the Federal Reserve pick up on that and continue cutting interest rates quickly enough to stop it from happening? That's what I've been seeing since really like mid-November, you know? So to me, the retail sales being negative spot 4, core retail sales being negative spot 4 in January versus the expectation of spot 3 is a huge miss, and is a more important data point than all of the other data that we got. So just working from that framework, and of course there is a lot of, but I don't want to call them assumptions, but you know, there's a lot of wiggle room in there on that, right? Like I'm making a really big play. We have to fill in a lot of information, essentially, right? But a quote unquote hedge, like selling 9,000 contracts in 2-year notes does not make sense from within that framework at all. Right? So I haven't seen an order like that and see it actually get filled in a long time. That's true. Now, question, Uzi. Was it like it got put out and it was on the inside, and then because it was there, you saw the market orders like snatch it up really quick? Like, was there large block buys in there? You know, like market orders larger than a few thousand, gobbling it up all at once? Or rather, would we call it like a high velocity collision? You know? Because the other thing is, I'm sitting here and I'm like, okay, if I had a ton to sell, yeah, hit the book at the inside, I stick away, down a tick, and then right up, and just all at once 9K. Yeah, okay. So it was like a high velocity collision. Because I'm also kind of wondering, like, okay, maybe somebody just had to sell today. Like, they knew because of their fund and whatnot, had nothing to do with retail sales. They just had to sell today, right? Why that particular price? Was it just like, well, that's the price that gives us the money and the wiggle room that we need? And yeah, we could make more than that, but we don't particularly care. So you just put it all out there? Because if I was executing that, I would be sitting there thinking, I should wait for the, you know, for the liquidity hole balancing sort of behavior happening up here, and slowly execute it, provide that liquidity up in here, because there's definitely going to be the buyers, you know? So it's a really curious order. But at the same time, it's like, it's the 2-year. I don't watch that very much, so I don't know, like, I don't think that I have enough experience, you know, because to me, if that happened in the 5-year versus the 30-year, would mean different things to me, right? Maybe it was. Does that make sense? If it was a spread, if it was a spread trade, the trade would be it's a sell. He's selling, so the spread, the trade would be flattening. Why would this retail sales news be a flattener? Now, that doesn't make much sense to me. Does that make sense to you? It kind of seems to me that every time that we've started to get concerned about the economy and stuff, that they go, oh, well, maybe they will cut interest rates, and they start to bring that forward, and that favors a steepener, which would imply you buy the 2-year, right? I'm also not really seeing any kind of really strong differences in the flow of market orders between the 3 main instruments to suggest that any major change in the yield curve is coming here. I am seeing a little bit of a shift between the 5 and 30, but it's not as actually was, well, in the 2 and 10, it was steeper. So the hedge still doesn't make sense in that context either. Well, I think that I have no choice but to chalk it up as noise. Interesting thing to note, but probably not something that we can claim a whole lot of information from. Other than that, yeah, you don't see that very often. That's true. Even in the 2-year, you don't see that very often. What is AO saying? The market's open on Monday? No. Well, yes. I mean, the futures will still be like here. I think that we will be here. Probably we're going to be doing some programming. I don't know. Unless for some reason yesterday I was kind of mad. Like throughout most of the day, it was just kind of like doing the thing, making sure that the kids don't kill each other, and making sure that we get everybody home from school and whatnot. I think that today I shouldn't have to do anything because the oldest teenager drives now. He should pick the other ones up. Should be good. I do, though, at about 10 o'clock Eastern time, do need to go and drive kids to school, which is going to suck because the little ones are going to have to come and just leave them alone. So we're all going to have to get in the car. But grandma will help us with that. And grandma is getting a colonoscopy today, so I'm not going to bother her with that today. So we do have to do that. I should kind of be like, get ahead of it, right? Like a 7:40. So like in an hour. Okay. But anyways, by the evening, I was just kind of feeling like a little bit pissed. And I don't exactly know why, but I think maybe some of it is just that the job search is still really rough. I had a lot of HR screener interviews this week. I think that they all went really well. I would totally expect them to invite me in for further interviews, but I haven't heard anything this week yet. Maybe they're not going to do it until next week, so probably. In fact, my experience has been that they're always a little bit later than they think, and that it's probably not going to be until Monday, Tuesday. Yeah, and then I'm looking at the stream and the YouTube channel, and I'm like, are we any closer to being able to solve this problem with the YouTube channel? No, we're not. And what am I doing to try and change it? To what can I do to... Well, I don't even know what it is that we're trying to do. I don't know. Like there's when I say like what are we trying to do? Obviously, what we're trying to do is we're trying to make enough income from the speculator Seth business to fill in the income gap and do this full time. That's what we're trying to do. And there's maybe a couple of different like directions you can go that might bring us there, right? But they don't seem to be working. One of the things was put out more videos. That does seem to be helping the channel, but it's not causing the channel to, take off. So what can I do? And then I think about like what I do on the stream and things like that. Like, well, we give good information. I do kind of feel like that how many people view the stream is really kind of down to YouTube, and that there's not a whole lot that we're doing here on the stream that affects that. But then there's some other things that I'm like, well, okay, but there are some algorithms and things like that, some sort of experiments on that side that we should probably be doing, that we've been putting off. I think part of it is that like, well, we want to do stuff with this main algorithm, right? I want to do stuff with our new indicators now that we can do back testing. Wanted to collect some data. Then, well, I have like almost 2 months of data now. We have more than 2 months of data now. So we can do that one. And the other one is there's a little bit more investigation that we want to do on spreads. Like I kind of suspect that there is some degree of mean reversion in spreads. So is there some way to maybe sort that out? I wouldn't necessarily expect that strategy to be like a super successful strategy necessarily, but at least enough to prove to ourselves if there really is that strong mean revert, or to let me put it more more specifically, my theory is that there is more mean reversion in yield curve spreads than there is other instruments, is my theory. So that's one that we can do. And then after that, I don't know, this watching this kid do that options thing. Well, I've never gone into the options thing because I don't really have the data to do the kind of analysis that I would want to do. So I really don't think that I'm going to be going over to options. But I really would like to try and find an arbitrage strategy. I definitely have the skills to do it. It's just a matter of finding an inefficiency. And the problem is, like, can we find an inefficiency like that in the futures? In just outright futures? Maybe not. Maybe not. Maybe it's just that the futures, that there's just not enough room for arbitrage like that. Yeah, you should fight with chat more and backtest their strategies. I mean, do you guys find that entertaining? Because I feel a little bit torn about that. Like, on one hand, it is entertainment. It seems to me that sort of a thing, like, gets people interested, gets people watching. And I'm not necessarily saying that, like, oh, I see that in our stats, like, you guys stick around more when that's happening. But just the overall, when I look at social media and stuff, that kind of content, like, really gets people engaged, at least in the short term. Again, I don't know if I honestly think that the only thing I can really do at the moment, aside from going viral, that would really change the viewership numbers on the stream is different thumbnail. But I digress. But the other side of that argument is we're wasting time. We're wasting time and energy on people that are just too dumb to really understand what we're doing or help, you know? Reality is you have to lie to the audience to get maybe. Or at least in the trading space, yeah. Like, it seems to me that, like, in the trading space, that I have to come out and say, look at how much money I've made from doing this, and that's what's going to attract the people, yeah. Just because if I look on YouTube and I look at the YouTube channels in the retail day trading space that seem to be doing the best, they all fit that. I can go to pretty much every single one of those channels. You're gonna see a thumbnail with, like, a huge number on it, right? The only honest YouTubers are the ones the audience believes in. All this bullshit is fake in one way or another. The audience has just been duped into believing it's different because it's not TV. Well, but I mean, what we do here is different just because we're so small. I think that you and we have, like, a real, like, I know I know things about you. I don't know everything about your lives or anything, but, like, I have an idea of your personalities. I kind of know how you trade, you know? Well, that's a little bit different from, I think, a lot of places where it really is like a one-way relationship where the influencer doesn't even know that you exist, you know? Do you make good money? No. Like one of the things that I'm trying to tell people here, right, is you get these people that say that they're making big money from retail day trading, especially retail day trading futures. They're one of three things. They are a scammer. They're just outright lying to you. They're naive. They don't realize how lucky they were. And their luck is going to run out, or 3, and is kind of similar to the second one, they are a degenerate risk taker. They are really doing stupid things, and that's how they got lucky. That's how they were able to make so much money. But in my opinion, the idea that a retail day trader is going to make a living from scalping futures is patently ridiculous. It's absolutely ridiculous. You already know big green numbers are what will drag the audience, and you need to lie about making more money. Bring in the... Well, I will never give my integrity. Never. I'll never do it. Do you tread? I would say for the most part we tread water. Like overall, we win a little, but because I trade so small, the costs are a relatively high portion of my profits. So we win a little, but it kind of ends up being tread water. Yeah. It's kind of crazy to think about. Yeah, integrity is why your YouTube channel won't get good, maybe. If I have to give up integrity for the YouTube channel to get big, then the YouTube channel is just never going to get big. 100%. I will never give the integrity. Integrity is the most important. Integrity, excellence, teamwork. Those are non-negotiable, right? So, like, we don't really think about, like, why would those be non-negotiable? But then when you think about it from within the context of the YouTube channel, it actually makes a lot of sense. Like, okay, so I'm not going to make the YouTube channel successful by lying to people about performance or something like that. And frankly, even if I was making a ton of money, I would not make those thumbnails because I still feel that making those thumbnails would be lying to the audience. Like, yes, you did make that money, but you're also kind of giving them the impression that they have the opportunity to do that too, and that's not true. By and large, they're going to lose money, right? It's a zero-sum game, so most people have to lose from doing it. That's just the way it is. Okay. Excellence. Okay, I could maybe make really crappy videos, and like cut corners and things like that. I don't think that would really make the channel successful, but it would certainly make creating videos easier. But I'm always going to do the best job that I possibly can. I'm always going to do excellence. Excellence is important. And teamwork. I could probably start making a ton of videos specifically about people, right? I mean, there are definitely people out there that I dislike. And I definitely make videos about things that I'm seeing going on in the retail trading community and things like that. But you notice that in the full videos, I never mention names. I never mention names in the full videos. Why? Because that's not teamwork, right? Like, making the channel big by tearing somebody else down, that's not how we're going to do it. We need to have teamwork. We make the channel big by helping other people. So something that I've been looking for an opportunity, like, I don't know, this is something that I want to do. This is something that I want to have happen, but I don't know what the circumstances would be that would ever possibly make it work like this. But, you know, I see all sorts of people out there that they're influencers or whatever, and they got into day trading, right? And then, like, they immediately start struggling, and they're like, oh, what the heck, right? And I see these guys go and, you know, try and copy price action, and they fall into all of the same mistakes, right? And I would really like to have a situation or one of those guys, like a Daniel Inskeep or whatever, that they came here and they learned from here, and they started applying what they learned here instead. You know? That's the teamwork. That's the, you know, these people that are struggling. Let's teach them what we know, because, you know, there are some people out there I guess one that comes to my mind a lot is Matt, because it really seems to me that like Matt takes risk. Like he's good at that part. He has had some success. It's just that like I think that the entire basis of his strategy is it's just gonna be random. It is still like technical trading, right? So that would be like a good opportunity to test the theories of things. Like, okay, so how about we have you focus on informational inefficiencies almost exclusively? You're only going to take a trade when you think that you have an informational edge. Like right now is a great example. I think I have an informational edge, right? We know what that number is. Most people aren't even awake, right? So the market's not open yet. I think that there's still possibly a good number of orders to come out and trade off of this news. Although we are getting to 50K, so I am kind of need to be looking for an exit, don't I? And I think that I kind of understand the significance of that number in a way that maybe a lot of other people don't, because we kind of been following the story and stuff, right? So like that's an informational edge. And then everything else that we know about the way that the market behaves and everything just kind of helps us to know like when's a good time to take it off, when's a good time to try and let it run, and all of those sorts of things. I could just say 16 ticks is enough, right? That's really good. That's more than we usually get. Usually you get 10 ticks and it comes back on you. Anyways. Yeah, I want to see some of those people that they're kind of established already and maybe more popular than us. And they go, okay, let's give Seth a chance and follow this and see how they perform. Right. Teamwork. That's the thing, is teamwork. So that's why I've been trying to do interviews. We got a couple, I should do some more reaching out. Kind of been reaching out to some people one by one, and some of them are just like, now's bad timing and things like that. But okay, I think I am going to place an order here. I have a lot of reasons to think that it's too early, but I am starting to see a lot of volume trade there. So this is a good example. Okay, let's just note right here, 22,500. Okay. So when I identified this as a place that could potentially become point of control, it was 22,500. Granted, the point of control is only 25. So the point of control is almost certainly going to switch right here. Okay. But I'm going to bet you that 45 minutes from now that there's going to be so much more volume there at 11 that you're going to be like, wow, how did you know that early it was going to be that spot? Now maybe I'm a little bit late too, because like we're already 1, 2, 3, 4 bars within this range, right? But it was only then that I started to really see the big transactions that start to create that behavior, right? So 16 ticks was considered a turning point in the bond pit decades ago. Well, yeah. I mean, I think that actually is a heuristic that you can kind of use a little bit. It's not one that really comes up for us very often because, we're day trading and usually it doesn't move that much. Like, to get 16 ticks is kind of hard, right? But like if you're swinging, there really seems to be this thing that like, it likes to move at least a quarter of a handle. It likes to move in quarters. And so you can kind of divide it up like that. And yeah. So let me give you a better example of this. Okay. people like round numbers. So if I'm trading ES, and let's say I want to go long, so I can go long anywhere between 132 and 134. Let's just limit it to that range. Is there a one price that would on average be better to get into than others? Well, people like round numbers. So there's going to be more limit orders going into it and more stop orders going after it. Right? So if I get in below 133, the advantage is I'm getting a better price. You get a lower price within the range or whatever the deal is, right? But if I get in at maybe 133.25, in theory, better chance of there being some stop orders that kind of help me a little bit. Okay. So I have definitely heard this thing that, like, and I don't know how I would test this, but that, like, you want to get in on the quarter. Like, never get in on the even one. Although I think a lot of the time I do get in on the even one. But I think you could do the same thing over here. This is like, if I want, if, you know, like the spot that I'm looking at is 448, you know, whatever the most round number is, you know, or like, let's say I was going to buy the micros here, right? I could do it at 447, but I think I would probably rather get 446, right? In the hopes that there's this chance that it will come back to 447 a lot, right? I'm going to come every day until I see at least a speck of consistent DOM flow, profitable trading. Thus far, I hear a lot of talking about it, but no. I mean, you just missed the trade. Wait, what are we... Oh, I have to refresh this, I think. No, it's the 14th. Oh, there we go. Now it's showing it correctly. Yeah. Or let's just look at this week. I kind of feel like Friday didn't count, but, you know, whatever. Yeah, okay, that's not bad. Not bad. We took 3 trades this week. 2 of them were good. 1 of them was bad. That one, I think I put a little bit too much size into it. Well, it was 5. That's interesting, but this one was 3. This one was 5. So that was maybe a mistake, but we got out of it quickly. So yeah, trading this week has been good. But I think for body bag, based on the comments that I've seen, I think that you're still kind of missing this thing that the primary edge comes from informational inefficiency, right? And DOM trading is kind of an optimization on top of that. I think, again, like the idea that you can come in and make a living from scalping futures, I think overall is kind of a foolish notion. But like coming in and trying to make a living from scalping futures by just looking at the DOM, even more fantastical. You'll get further than looking at a chart. But I just don't think that there's enough edge in that for a retail trader to be profitable on that just on its own. Need to master breakouts because your best trades have to break out. Well, but I think that we kind of do though, right? Like when I take a trade, I'm usually looking for things that are likely to break out, and they do. So if I look at my own trading and where I feel like that my own trading has issues and where it's good, I think that the problem always used to be, well, it seems like sometimes it continues through and sometimes it doesn't. And how can you tell which one it's going to do? And I remember doing all of this kind of searching and, well, does this indicator help me predict that? Does this indicator help me predict that? And once I moved over into basing my trades on informational inefficiency and switching my view of the markets over to the order flow view of markets, I'm able to predict when that's going to happen very, very well, because I can use my informational inefficiencies to predict future orders, know how many orders are going to come through, and then be able to determine if that's going to be enough to bust through that range or whatever the deal is, right? So that I don't think is as much of a problem anymore. Where I think that the biggest problem is sizing orders, right? I've always been all in, all out. Now there's this sort of thing where like I can take sequential profits, I can scale into things. I know that in and of itself doesn't necessarily help me, but it can kind of help from a psychological perspective. Maybe from an informational, maybe there are some things that informational inefficiencies that might help me optimize those even further. I don't know, but I feel that sometimes I will size certain trades too big. It would probably help if I was trading, like if I was trading 100 contracts and then like there was so much more room to be like, how many contracts am I going to trade? Maybe I would be better at that, learning from that. But we got to do it practical. I'm only going to be doing like between 1 and 5 contracts right now. So that's, I think, the biggest one. I think that's the biggest one. A place that's I've always kind of struggled is, okay, if I'm not really expecting a really big meta order, then I just stay out. And maybe there's some room to make money in those places. Like, especially with our inventory cost basis and all that sort of stuff, like maybe there's some room to make money from that, right? We are starting to have some progress in that space. Sure. Maybe there's some spots where like there are certain pieces of information that I'm aware of, but we're not able to incorporate into our trading very often because they just don't get the news. So there's those, and I don't know if there's anything we can do about that, but that's also a really big weakness, right? And more broadly though, like we can really have strong edge from informational inefficiencies. But the issue with the informational inefficiency approach is the consistency of it, right? How well I'm going to do depends on how well I know that market. And there's absolutely no guarantee that I'm always going to be at the top of the game, that I'm always going to be the one that knows what's going on, right? I only have so much control over that. And so how do you deal with that part? How do you avoid getting into these markets where you just don't know what's going on for a whole quarter? Because that's often happens to us, right? So those are the biggest weaknesses in the strategy. Yeah, every week you get a runner day, especially on CPI. Yeah, like this week. Capturing the move because buy, sell, stop, spillage. Yeah. But I would say that I've traded these ones really well this week. Like not only have I caught good runners, but like this one this morning, only one tick against me. Literally one tick against me. And that was, by the way, a trade that like all of the moving averages and everything were pointing down. Like Like that was the pullback. That was on the pullback. I just picked the exact perfect spot. Like that was good. If you want an example of watching the DOM to maybe get a good spot, to maybe get a good price, I think that today's trade was a good example of that. I mean, there's a lot of luck involved in it, of course, but it worked really well today. And to be honest, on this one, I don't think I completely understand how I saw it, but I just kind of saw it. It was like it was pulling back. I could kind of see based on the volume that was trading there and the way that the level 2 was kind of flickering around that was kind of like becoming a gravity point, and that was kind of the place to take it. Okay, I agree with your views on order flow, but volume profile, VWAP, cumulative delta are all part of order flow. Okay, so let's get into that. Sure. Order flow, in my view, is the study of all orders in the market, particularly studies that require the use of market depth in order to do. Okay, so order flow is basically about data and not about analysis, right? Order flow is about data and not about analysis. So we can do all of these sorts of things, like we can sign orders. So we can say what is the best bid, best ask, and what price did that execute at, and then determine whether that was a market buy or a market sell. And that's like kind of like the key basis of order flow. And then there's a lot of things that are kind of get a little bit more complicated than that with the level 2 that might, the things that like my indicator is about. Okay. Well, what about volume profile? Under the definition that I just gave you, volume profile is not order flow, because to do volume profile, you only have to know what price the order was executed at. So, but it's like the study of all orders in the market. So we can kind of have our definition fit volume profile if we want to, right? But just kind of realize that volume profile in particular is a little bit different. Okay. First of all, candlesticks are more order flow. Okay. But then you get into this other thing, which is, okay, there's all of these ideas about how volume profile works. Like the classic setup that I always talk about is that here you have, here's the point of control. Here's the POC. Here's the V value area high, value area low. And then they say, if we open up below the value area low and we come back into the value area for more than 30 minutes, then we are extremely likely to get to the point of control. That is a very specific setup that Jim Dalton in his book Mind Over Markets talks about. Right? This to me is technical analysis applied to order flow. And is therefore very questionable. So you notice the things that I talk about and focus on in the order flow are things where like we have a very, very specific statistic that we can cite about it. This thing right here, it's point of control, value area high, value area low thing. It's sort of like you only get so many samples, right? Because you only get one sample a day. And so in order to get into tens of thousands, right? What is 10 100,000 divided by 250 trading days a year is 40. Okay, so like you don't get to a place where you really have enough data to do something with that until you've been doing it for 40 years, right? So when Jim Dalton created all of those things, it was kind of like, well, these are the most clear aberrations we can see in our data right now. I don't know if he realized or not that that wasn't enough data to really be saying that there's some sort of like proven behavior of markets, right? And more broadly, the tendency for a market to come back to the previous day's point of control is not a widely recognized stylized behavior of markets, right? When you look at the things that I talk about and I teach in the order flow videos, which is partly what are you actually looking at? What are the sorts of things that you tend to see in there? And then I get into what are the proven behaviors, right? The most significant one, in my opinion, being the high autocorrelation in order flow sign, which is to say, if I take an order and I say, is it a buy or a sell? Was a market buy? Okay, then I pick another random order an hour from now, it will be a 0.5% chance of also being a buy. And there's all this other science behind it, but I'm sure most of you guys have heard this a trillion times before. We believe, or the best evidence that we have suggests that the reason that that market behavior exists is because of really, really big institutions executing large meta orders over long periods of time. Okay. So that's the biggest one. And that is something that you get thousands and thousands and thousands of data points every day to verify with. And so we're able to prove those statistics very, very well, right? And they really have nothing to do with, you know, they're actually quite simple. They're very much, you know, how it does the structure of the market make that happen. So let's just acknowledge that the things that I talk about and I focus on are very, very different in nature to volume profile, VWAP, and footprint charts, right? Okay. That doesn't mean that there's not any edge in those things. But then we come back to, okay, well, how are these actually used? And when I look at the way that retail traders use volume profile, candlesticks, VWAP, etc., I see all of the same fallacies that traditional technical analysis is prone to. So I don't necessarily have anything wrong with opening up a volume profile chart or opening up a footprint chart and doing some analysis based on that. But I would have to have some sort of proven piece of information that shows me that there really is a well-proven market behavior in there that we're relying upon. And there is no such thing in volume profile and in footprint charts. Or at least the ones that are. So there are some things that I would say like are kind of like proven. Like so much so proven that like nobody would debate it. It's just you can see it. But the problem with those are that like they're coincident, right? Like, yeah, for cumulative delta, for instance, okay? On average, when price moves up, cumulative delta is also moving up. It's not perfect, but by and large, if cumulative delta is strongly moving in one direction, you will also see price. It's like broadly speaking, that's true. But this doesn't help you because well, it's those orders are what's moving the price. In order to do something predictive, I have to predict those orders are going to come before they come, right? So there's that. So yes, you really are not going to see me. So like, I think that what people expect me to do is to come into this, when we go and we look at our charts, because I have a volume profile on here, right? And do the Futures Trader 71 thing. Okay, well, we have this point of control down here, and we have this point of control up here. And so we have one scenario where it's going to come down and do this, and then it's going to come back. Like, I really think that that's all nonsense. Really do. Like, yes, you can come in and generate statistics based on these things, but they're kind of really questionable statistics for basing a trade off of. And those statistics don't necessarily include risk reward and all of these other things. So yeah, I kind of just ignore those things. There was a time when I would do this. You can go back on my stream. You go back far enough. I would have all these things. So it would be like, okay, here's one scenario I think is going to happen. Here's one scenario that I think is going to happen. And here's why I think why I think those scenarios, like here are the statistics and so forth that makes me think that those things could happen. And then we would sit and watch the order flow and be like, is that actually happening? Right? Just didn't work, man. Like it just, and the more that I learn about the markets and statistics and everything else, the more that I'm kind of like, I kind of think that that's a bullshit approach. I don't actually think there's any edge to it. Well, you illustrated a couple of times a great observation of order flow where you show the volume profile with two high profile nodes with a hole in between it and what causes it and how bright. Yeah, but then, I mean, this is the whole thing is that like the volume profile traders, right? So you kind of have to come back to this thing that's like, what is a prediction, or maybe like likelihood, right? People have this idea in their head. I'm going to see a pattern. I'm going to see that there's this node and then there's this node, and price kind of was like, okay, it was here for a while. It came here for a while. It moved here. It's failing. Ergo, I will see it come all the way back to there. And this is the way that people think, right? It's kind of built into you from evolution, right? So the pattern is profile, failure. It should extend back down to this, and I call this, and it would be like at this particular point right here. I call this a setup. Not a setup, a setup. And what I'm trying to say is that setups in and of themselves are bullshit. This sort of thing that like you can set up a very specific set of conditions and then take a trade based off of that on a day trading basis. Everything that all the data that I have says that doesn't work. Setups don't work. Setups don't work. Setup being taking past data and using that as finding a certain aberration in that past data where if you take a trade at this point with a set risk reward, that over a certain number of trades that will result in a profit on a day trading basis. Right, on a 1 minute chart. Even if you're including cumulative delta, my view is setups don't work. That's technical analysis. It doesn't work. My view is this. What I would call a setup is an informational inefficiency. I believe that a certain number of orders will come into the market in a certain way over a certain time period. Okay? So if it's a really large meta order, then I think that you're going to see net buying of a certain amount. They're going to try and take as much as they can on the limit, but at least 50% of that is going to be market buys, and it's going to push the market up, right? Now, I can kind of look at the past market action to make some understandings of the liquidity conditions. So what is the liquidity condition that we know of right now? And by the way, remember when we first pointed this out, it was only 22,000. Now it's almost double that, and you've got a little bit more of a profile, okay? Because there were a lot of large transactions and we spent a little bit of time there, market makers are a little bit more reluctant to offer a lot of liquidity in this location. It's been long enough that I think that we could probably move out of here if we really wanted to, but it kind of looks like that the trading is done for now. Anyways, so if I had this theory, maybe I know of a piece of information that's going to hit the market and it's going to cause a lot of selling, right? Well, then I know that there's probably going to be more liquidity when we get into this kind of area right here. But if that imbalance that I'm expecting is big enough, they're going to plow right through it. So it's going to be, it's be a little slower through here, and then it's just going to take off, right? So what I have is, should pull up the right thing in here. I have informational asymmetry, which leads to a prediction of order flows. And then I take my predictor of order flows plus current liquidity positions, or current liquidity conditions, equals trade. Right? And that's my approach. So I am really not, the reason for me taking in the trade has really nothing to do with what happened in the past, right? What happened in the past affects it because it does have an impact on the liquidity. But that's not the reason I'm taking the trade. The reason I'm taking the trade is because I expect certain order flows to come in. Quite frankly, you should be able to take the trade just on the predictor of order flows. This part right here is just kind of like an optimization to make the trade easier for you to hold, right? Getting the right spot. So let's take a more real example. What happened this morning? We had a retail sales report. The report came out. Of course, we immediately spiked up and pulled back. And I looked at the number, negative spot 3 versus the expected spot 4%. So really, really big miss. I think that the retail sales matters more than the PPI in this particular case. So I expect there to be pretty strong flows coming in after that. So I want to go long. So that's my theory is over the next hour. And when I say this was all an hour ago that this all happened, right? I'm saying in my head, I think over the next hour that there's going to be like 50,000 contracts net long coming into the 10-year treasury. That's the way that I think about it. Okay. And I want to go long. Then the question is, what price do I take? Because It's up here already. I can buy the high and hope that it just continues pushing through. Or it's going to pull back. I can wait for the pullback. How far is it going to pull back? Is it going to pull back all the way to the open? If I take it here, is it going to really go against me? I want to minimize it really going against me because I don't have a whole lot of, room to risk. So what I do is I just kind of watch the order flow. I could see off of that immediate jump that they were getting sucked back into the liquidity hole that's caused from behind them. Okay, I wait, kind of saw a place, and where did I take my trade at? 03? Yeah, it was all the way down here. Okay, it was all the way down here at 03, and I could kind of see it going back and forth across this price on not a lot of volume being placed. Not really any desire for the market sell orders to continue coming through and push here. So I used the current liquidity conditions to select that price for buying. But that wasn't why I bought. Why I bought was because I expect the retail sales number to continue to drive orders throughout the day. Right? And then on the other side, I also did it with my take profit. I went and I looked at, I remember I said I'm expecting about 50,000 contracts or something. I looked over at cumulative delta and I saw that we were already net 50,000 contracts long. So I've already kind of seen at least the initial amount of volume that I was expecting. Doesn't mean that it can't continue, but I was just seeing what I was expecting. And then I started to see the kind of little bit of that liquidity hole behavior again, like really big transactions in that spot and it moving in that 2-tick range for a couple of bars. So what do? I take it off. And what do you know? It's been almost, when did I close that trade? 6:58. So it's been almost 30 minutes now, and we're still there. How did I do that? Well, I just know when we create a liquidity hole, we kind of get stuck in that area for about 45 minutes. We're in a spot now where I think that you could get another move, but it doesn't look like anybody wants to take it. Doesn't look like anybody wants to take it. So probably the only trade we take today. Unless something else here really happens that really makes me think that there's going to be a large, a future imbalance. Okay, well, now we get into the spot where there's the positioning model, right? And so based on what we're looking at, the average position for the market maker is all the way back at 06.5. So there's a really good probability that before the close of business today, that there is a fallback to that place. You could try taking the trade. I don't know if you take the short there or how you sort that out. It seems like when I try taking it, it doesn't work out. I think that this one, I don't have enough of a situation to make me think like it's going to happen now to take a trade, but you could possibly take a trade based off that, right? But that's how I trade. So again, you have a predictor of order flow plus the current liquidity conditions that results in a trade. So that's the approach that I get. And you're never going to hear me talk about these things like on a volume profile. I made a video about that. You can go watch if you haven't watched my video on improving volume profile. Because there's one really well proven statistical behavior in volume profile. There is one. And that is that volume profiles tend to follow a normal distribution for some reason. Well, you go watch the video. It explains why that happens. That in and of itself doesn't result in probable trades. Informational inefficiency is what results in probable trades. Live action, Seth, you have a lot of commercials. What do you mean? Oh, you mean on the YouTube? YouTube sends a lot of commercials? I'm sorry. I created my own volume profile for Ninja. Should you post it? Well, sure. Oh yeah, hi Seth. So why sometimes you start the live already in profit? The Discord we can see the trades you take in ETH. So if you're talking just about like the number above my head right here, right? That is coming from over here on NinjaTrader, right? So the number that it's displaying right now is the number for this week. And I can kind of change it around because most days I don't take I didn't take a trade yesterday, right? I took 3 trades this week. It's Friday. So I only traded 3 out of 5 days. So like, and the reason that I used to not even show the number, but I put the number up there because I think it was AO, but I don't remember who it was. Or maybe, oh, there's a couple of people. I can't remember who it was. But they were saying, oh, this will probably improve viewership if they can see it like a green number somewhere. So we put that up, but that number that you see might be just today. It might be the week. It might be the month. It just depends on whatever it is that I feel like highlighting to you at the time. And so that's what that's about. And it should also point out that right now all of my trades are sim. I mean, I have a live account and all of that sort of thing, but because I am unemployed right now, like I don't have the day job, I really don't want to risk the account. I want to, you know, ensure that we have the account and the data for as long as we, you know, I'm really trying to buckle down for the long run. Hopefully that we fix this all before the end of March. But I think there's a realistic scenario where it takes more than a year. In current market conditions, it could take more than a year. And saying that makes me want to cry. But like, that's what we're facing right now. And so I'm, you know, minimal risk to keep things going as long as possible. So that's why there's some trades. Otherwise, we would, you know, we'd be taking trades in micros at least. Okay. And, you know, this is kind of where we got into this conversation is we were saying, you know, like, I'm really frustrated because I'm running out of time and I don't know if there's really much more I can do other than continuing to have the output and putting applications out and doing interviews. But a lot of it is just me being subject to the current market conditions and the current labor market. I feel like I have a lot more control over what happens with the stream. I feel like I've put a lot of work into the YouTube channel over this period. Doesn't seem to be resulting in a whole lot of... I'm not getting a lot of reward out of it. Then we have days like yesterday where I spend most of the time arguing with somebody because they don't want to believe the empirical data. And I'm sitting here like, okay, is that really helping the channel? Or is there something else that I should be doing that would be more effective at helping the channel, you know? That's why we're talking about all this. Okay, if big players are methodically placing their orders in the market, those would be displayed in the same manner on a chart, creating recognizable patterns. The only way that wouldn't be true is if players are dropping orders randomly and differently every single time. Okay. You're on the right track. I mean, there are recognizable ways in which these guys execute. And you can see it on a chart. The problem is that seeing that on the chart does not predict what you're going to see on the chart in the future. At least not very well. On a day trading basis, right? By the time that you see enough of a pattern to have a really... So basically you could write an algorithm or some sort of an analysis sort of a thing that is there a large meta order being executed in the market? Okay. So the more trend that I see in price, the more autocorrelation I see in cumulative delta and consistent imbalance, between market buys and market sells that I see in the order flow, the higher the probability is that there is a large meta order at work in the market, right? And the issue is that basically the way that it works is by the time that that algorithm would say it's highly probable that there is a large meta order at work in the market, they are done. Or at least they are done with that leg, right? So yes, you can see the pattern, but the pattern is the result, and it doesn't predict anything about what's going to happen next. And this is the ultimate flaw in technical analysis, is that this is just this assumption that the past data somehow will predict the future data. It just doesn't, not on short time frames. And you know, basically what has happened is the retail trading community has just completely misunderstood where quants were getting their edge from, right? And it's in all of the resources that they're reading. It's just you don't have enough context to really understand what they're saying. Like if I go and I take the technical analysis of stock trends over there, the very beginning of the book, they talk about the efficient market hypothesis. And what did they say? The market is extremely efficient, but it does tend to trend over long periods of time, is what the technical analysis of stock trends says. Okay. It's true. It's true. Momentum is a thing. There's a lot of complexities to be able to take advantage of momentum, but momentum is the thing. Right? Doesn't apply to a day trading basis. So over very, very long periods of time. Mm-hmm. It's not that like the past pattern predicted something necessarily, as much as it is just we find the thing that is moving and we get in on it. Is technical analysis also indicators? In my opinion, technical analysis is the study of past prices and trying to predict future prices based off of that. And there's lots of different ways of doing it, right? Because you could just be looking at the current candle. That's what price action people do, is they look at the current candle relative to past candles. But it's primarily about what that current candle is doing relative to them. Sometimes it can be broader patterns that we think we see, like a head and shoulders pattern. Sometimes it can be these kinds of more statistical analysis of a price series, like a Bollinger Bands or stochastics or whatever the deal is, right? And what I'm saying is that all of that, the analysis of past price, is almost completely useless in a day trading basis. So there was a thread here. Next time you see one of these, I don't know, you guys don't do Reddit. I'm really kind of burnt on Reddit. That website is just going crazy. But you're seeing threads like this almost every day now. Is day trading bullshit? I've been actively day trading since 2018. Okay, I've taken thousands of trades. I've done hundreds of back tests. I've tried trend trading, momentum trading, small caps, large caps, breakouts, pullbacks, you name it. I've tried it. And after 8 years, I've got nothing to show for it. Every time I think I've figured something out, I take 1 step forward and 2 steps back. Is day trading bullshit? I'm not seeing how it's remotely possible to be a consistently profitable trader over the long term. Whenever you see a thread like this, here's what I want you to do. Look at what they tried. And I will bet you that you will see talks about technicals, right? Trend trading, momentum trading, small caps, large caps. That's just trading which asset you're trading. You're trading breakouts, pullbacks, etc. He's technical trading. My assertion is technical day trading is bullshit. There can be some things in the technicals. I'd say that it's, if we're going to consider order flow technicals, There are some things in the order flow that can help you. But by and large, trying to trade purely on that is it's not very effective. In my opinion, the only way that you're really going to have even a chance at success in day trading is with informational inefficiencies. Maybe I should just not be using such complicated terms. Maybe I just need to say, hey guys, we're fundamental traders here. Yes, we're day trading, but we trade fundamentals. Is what I should say. That's people would understand that better. My opinion is that fundamentals will bring you more success in day trading than technicals will. That's my assertion. Go and look at those threads. They will always list technical things and never fundamentals. You never see these guys say, well, I'm trading news, or I'm trying to predict economic releases. They never say that. It's always technicals. They're all trying to trade technicals. And I'm just telling you, on short time frames, it's just martingales. The past data doesn't predict the future data at all. So all of these technicals and stuff, it's completely useless. Technical analysis is, by and large, it's bullshit for day trading. Well, technical analysis overall is bullshit, but then you have to get into what is the definition of technical analysis. Because momentum is a thing, and some people consider momentum technical analysis, but momentum is not anything remotely close to what, it's not like pulling up a chart and saying, oh, I think this one's going to go long. And no, they don't do it that way. No, man, body bag. You just said like one of the things that is like such a big pet peeve to me. I would hope every trader understands past behavior isn't guaranteeing future. It's about putting probabilities in your favor as much as possible. No. I'm saying that you have a set of principles that you're trading based on that are all based on analyzing the past price and trying to take trades based on those past prices, looking for setups, and over a large enough sample of trades, that will just come back to break even. Okay? I'm not making some assumption about, like, I assume that we're all traders and that you're all smart enough to know that I'm not necessarily saying that you have to know exactly what's going to happen every time. And if something works, it should work every time. Okay? Don't be autistic. That's an autistic thing to say. And listen, I have an autistic son. So when I say that, I'm not saying it to insult you. I know it probably comes out like an insult because I am a little bit fired up. But I'm saying it because I genuinely think like that's an autistic thing, and like maybe I say that, maybe somebody realizes that they are autistic. Like, okay, consider the context here. We're not saying that it's going to work every time, but I am saying that over a large enough sample of trades, if all you're doing is trying to look at past market generated data to predict the future, that it's going to come out break even over a large enough sample of trades. Technical day trading is ineffective. Yeah, why are you haggling over definitions? How you define momentum may not be... so because I'll tell you why, on momentum here in particular. Because momentum describes a very specific type of strategy that became popular really in the 80s, although I'd say it kind of started in the 70s. And it's a swing strategy. It's like a type of portfolio. You go into the industry, there are momentum funds. A momentum fund means something very, very specific. I know that retail traders, they think that anytime that something is moving up, that means momentum. That's not what the word means. So retail traders co-opted the idea because they didn't understand it. So on that one in particular, I'm going to say actually there is a very specific definition of, because when we're talking about words, right, I guess we can define words any way that we want, right? I say that we should define our words based on what is the most helpful to people. And so in my opinion, allowing people to call everything momentum is kind of harmful to retail traders. It's one of the main causes of why most retail traders are immediately led into things that aren't effective. Is because they know that momentum is a thing that works, and then everybody calls what they're doing momentum when it's not. Okay, so when I talk about momentum, I'm talking about a very specific type of strategy that there are many funds out there that make good money on. And those funds do not incorporate fundamental analysis at all. Okay. But they aren't day trading. That's the key thing. Now, are there big funds out there that are day trading without any fundamentals at all? Yes. But the strategies that they are doing, market making and arbitrage, require either scale, lots of money to deploy so you can take multiple contracts and manage an inventory, or fast. Okay. Well, classical technical analysis would adjust your expansion to take into account. Well, so that's where I would say like there's a difference between technical analysis and quantitative analysis, right? Because quantitative analysis is just we're doing things based on numbers. We're taking actual computer data series and we're doing analysis on it and things like that. And then that's a huge world. Like arbitrage fits under quant stuff, right? So to me, the thing that kind of makes technical analysis different is this specific idea that past market generated data over some distribution predicts future market data. That's the very key part of the issue, right? Okay, guys, I have to go and check on the kids. I will probably be back in about 15 minutes, all right? All right, guys. So I know I said that it was going to be like 15 minutes, but it was more like 45 minutes because I didn't anticipate that children would be late and I had to go drop something off for my mom and I had to take the babies with me and all that. So it took a long, long time. Let's see here. Man, you guys had a real discussion while I was gone without me, huh? Well, so first of all, it looks like the market is still pretty close to where we were. Though it does look like there was a brief extension beyond. For some reason, I remember that peak in the volume profile being at 20 and not 11. But still, I mean, man, now there's 80,000 contracts been traded there, right? And we picked it out when there was only 22. Man, this goes so far back, I'm not even sure where to begin, guys. Classical technical analysis. This is where I left off, was live action, I think. Classical technical analysis is BS, but adjust your expansion and take into account current conditions. There you go. Yeah, well, and more broadly, like when we're talking about order flow, so fundamentals, for day trading, fundamentals beats technicals. But in order to really understand the fundamentals, how the fundamentals affect markets and affect prices and things, you really have to watch the order flow and not the price. Because the thing that you can predict is the number of orders that are going to come out. How far it's going to move and the way that it's going to move is going to vary based on the number of orders that are sent in and the current liquidity conditions. So you really can't make super effective trades without understanding those liquidity conditions and watching the order flow. Okay? But just realize that the edge is in the informational inefficiency. Okay? With all those firms that algos use to trade, very little of it is done manually. Yeah. And I mean more broadly, though, like they're playing a different game. They're just playing a different game, and we're not necessarily competitive on that game. I watched the standing pre-market orders being executed at the open once, and how they're all bunched together looked awful fishy to me. I refuse to believe that anyone can watch 5 DOMs and decipher all those orders and successfully trade off of it. Oh, okay. Well, so we can explain that. I can explain that and why you might not see that. But let me try and read through what everybody else says. I do it every day. It takes practice, not as hard as you think. So you watch nothing but the DOM? If so, well, yeah. I pretty much watch nothing but the DOM. I mean, I have charts over here, but I don't really look at them. I only look at the charts because I can't fit enough DOMs on there. There's a couple of features that I would like to have added to DOMs that would maybe make that more practical, and then it could be all just DOMs, perhaps. But there are some things where I don't care enough about what they're doing to look at all of the order flow on them. Do you reference the volume profile that... No, not really. I mean, I notice... so when I'm looking at the volume profile, I'm really kind of more interested in how many contracts have traded at that price total. And I kind of have a feel for how many contracts will trade at that price total. But I don't look at this shape and say, okay, here's the edge of it and I'm going to take it here. And no, this doesn't work. And instead, what I'm trying to do is I'm trying to predict what the volume profile will look like. When I take a trade, it's flat. There hasn't been a whole lot to trading there, and I'm trying to predict how that distribution is going to come out. Right? and we can use some things that we see in the DOM to predict that actually quite accurately from what I've seen. The chart is just the tape/order flow broken down and displayed graphic. No, it's not. It's absolutely not. So I don't, man. Okay, so wait. There's too much in here. There's too much in here. Okay, so one, we need to explain what we're looking at and how you view multiple DOMs at a time. Data that is in the orders that isn't on the charts. I have a delta histogram attached to my volume profile. Pretty sure he's not arguing that it's not based off the same data. What he's arguing is that you can't go into that data on the chart historically and recognize past patterns that predict future price. So a very good argument there, Julian. Like, I think you kind of seeing what he's saying really well. Yeah, the chart doesn't tell you if it's a market buy or sell volume on each ticker, the delta if it's positive or negative. Yeah. We're talking milliseconds between a DOM order is executing in a tick of the candle, so don't pull that the DOM is real time and the candle is lagging. Well, I mean, there is an issue with technical analysis in that it's lagging, but that's not the issue in this particular case that we're talking about. I don't understand how hard it is to say that you don't need a DOM, but it does provide a context that DOM isn't going to make or break your trading. I don't know, Uzi. I don't know if I believe that. I really do think that there are important behaviors that I can only see on the DOM that are really necessary for me to understand the market. And if I'm trying to build an trader's intuition, like I'm trying to trade fundamentals, but I need to understand how those fundamentals actually play out on the market. Because I can have one situation where the news comes out and it's good and the treasuries will sell. And then I can have another situation where it comes out and it's good and the treasuries buy. And why is that? And what's the difference between that? And you can kind of see sometimes in the flows the differences between those, and more broadly, like how many orders are going to come out, because some of it is that they could play out differently because of the liquidity conditions, right? Things that I would only see on the DOM. So I really think that if you're trying to build that trader intuition, that being able to watch the actual orders is really important. Now, I think that there are a lot of things that I am looking at the DOM that you can duplicate on the charts. I mean, the most important thing is the sign of the orders. So you can put cumulative delta on a chart. But I tell you what, if you're trading and you're using a chart and you're not using cumulative delta, then I almost kind of feel like you're just wasting time. In all seriousness. I can look at a 15-minute consolidation in a chart, and I don't need to look at a DOM to know that it's been fluttering between the high and the low of that zone. Yeah, but again, what you're missing is that I can tell you 1 minute into that 15-minute period that you're talking about that it's going to start that range. I think that your DOM is giving you an edge in execution time as compared to a chart may be the most ridiculous thing I've ever read on a YouTube chat. Okay, so the executional advantages of the DOM. Also, we need to make sure to pull up the kids because they're over there watching TV now. So I just kind of need to be able to see them. think that they're old enough now that I can have them watching TV like that, and then especially since they're probably just going to be kind of sleepy here still for another 30 minutes to an hour. Man, why is this not as fast as it used to be? No, I didn't say I don't really look at the DOM. I'm not... Did I say that? How can I send you my Discord? You message me on Discord, you can send me a picture. Come on. Okay. So what are we looking at, and how are you viewing multiple DOMs at a time? Well, so we are primarily interested in the market orders that are hitting the market. So when I'm looking at the DOM, I'm basically just looking at this area right here. Okay. I don't really pay that much attention to the stuff outside of there. Okay. And it's really going to be, what's your Discord? It's in the video description. There's two, there's the $3 Discord and there's the free one. So you could just go to the free Discord and then you could message me there. Okay. Make sure that you have your privacy settings set to accept messages from people that aren't your friends. And then you can just send me a message without having to add them to be friends. This is a dumb thing. Is like, you would think that if they set that you would still be able to initiate once, but you can't. Like if you have that setting set, then you can't initiate conversations if they're not your friend. It's kind of dumb. Yeah. You don't have it. You probably have to go through some setup because you might have to have your phone number verified and stuff like that, but it would be pretty quick. It can take you a few minutes. Okay. Anyways, and what I'm looking at here primarily is one, how many orders are hitting, like the market orders that are hitting here. You know, the number of market buys to market sells. I'm also paying attention to, though, how many orders it takes for price to tick up or down. And if it ticks up and then it ticks back down and then it ticks up again, how many orders did it take the first time versus the second time? Okay. I'm also paying attention to, how many bids or offers there are. So right there, we had a tick up. Okay. And a pretty good stack at 12. So now I'm looking at that 12 half. What does that 12 half do? It's still at 4,000. It's not really pulling. So there's decent liquidity there. That liquidity at 12 half, it wants to be filled. Okay. So that's what we're looking at. Now I have these other instruments. I'm primarily paying attention to the order flow in the 10-year. So why do I have the other ones up? Well, because there are spreads. There is spreading behavior. And so I'm also kind of watching when we tick up, do all three of them tick up at the same time? Am I seeing the same kinds of volume behaviors in all three of them? Or am I seeing a little bit of a shift where this one is actually selling more and this one is actually buying more? And that could potentially clue me on to a trade that's happening in the yield curve that I also have to factor in to my order flow. So especially if you're trading ZB, you could have this situation where we're moving up, but you see all of the market orders are selling and you're like, what's with that? Well, it's because of the spread. And if you can't see all of these next to each other to see that the spread is changing, then you're going to misinterpret the volume, essentially, right? So now the ES over here, I don't explicitly pay attention to that unless I'm seeing a clear correlation. So I can kind of see that out of the corner of my eye and see if okay, the S&P 500 moved and then I saw a shift in the treasuries, right? So that's why you have all of these open. Yes, with some practice, you can absolutely watch multiple DOMs at the same time. And for most cases, if you're going to be trading with the DOM, you're going to want to have more than one open. Like I see some guys that they just have they have the chart open and then they have a DOM open next to it. And I think that they primarily have the DOM open next to it so that they can execute better, right? And I think that you're kind of missing out on some of the benefits of the DOM, because even if I'm going to trade equity indexes, I can have the NASDAQ and the Dow Jones futures up as well and notice the differences between those, and that can help me pick up on certain little nuances. Okay. Number 2. Well, let's go to number 3 first, the executional advantages of the DOM. So the executional advantage that I can get on the DOM is, one, I can select which price I want to take very explicitly by where I click. Like, there are some things where you can chart trade, but it's kind of like I have to, you see my little cursor up there in the upper left? I kind of am looking at the little price marker to see which price it is, and then I'm clicking on it, right? So if I want to click on 109 EV, or let's say I want to click on 108.30, I don't know exactly where that is over here. So I kind of have to move it until I get to there, and then I could click, right? Whereas on the DOM, I can see exactly where it is, and I can instantly put an order there. So the ability to instantly put an order at any one individual price with one particular click is a big advantage to the DOM. And then the other part of it is that because I can see the market orders and the limit orders hitting into each other, I can kind of make this decision about whether I want to hit into it with a market order and try and catch the edge, or if I want to try and put a limit order there. You know, if there's not a lot of contracts at 13, like if it ticked up and they don't put a lot of contracts at 13, it's a really good chance that I could click there and put a limit buy order and get filled, right? And so there's also that if I'm not sure I want to put a market order or a limit order, I have all of the information that I need to make that decision right there. So there are definitely executional advantages to using the DOM just in and of itself. And that's another thing that I really like about Jigsaw, is that, like, if I want to take an order at 13, you know, if it ticks up, it will just make it a limit order. You know, it's contextual. So that's really cool. Oh, you sent me an invite. Oh, okay, let me see. Oh, I see it. Yeah, okay. Have you built a strat around what you're describing? So I think that we probably could program that in NinjaTrader, but that would just be like, in NinjaTrader, use the advanced order handling to decide exactly how you're going to execute it, right? You wouldn't be able to build an edge around that specifically, right? Because in all of these situations, we already know if we want to buy or sell, right? It's just, how do I buy and sell? Do I use a limit order? Do I put it here or here? There's some information that can kind of help you do that. And like the timing of it matters. So like being able to, like, if you want to hit into the offer just as it's about to clear so that you catch the edge, you're going to want the DOM up to do that. Okay. And that's where you get into like high frequency trading strategies are kind of based around those sorts of things. Okay. Number 3. The data that is in the orders that isn't on the chart. Okay. So you can have a situation where the chart is moving up and cumulative delta is flat. The orders, there's just not a lot going on. So the person only looking at the chart, and this is really very common in the treasuries, in fact, is you get a person looking at the chart and they'll be like, oh, hey, like there's a really good trend going on here. I should get in on this trend. And those of us coming over here and looking in the order flow are kind of like, this is lackluster behavior, because we can see that like there's not actually a strong imbalance in the orders. It's probably a correlation. I don't know when that correlation in the dollar is going to change. And that can keep us out of bad trades. It really, really, really helps. That was one of the mistakes that I made early on is not understanding that sort of thing and always thinking that when price had moved up, that's a trend and I need to get on, right? So the chart does not show all of the same information. And there can be really, really key information. So it can be the other way around. You can have an imbalance occurring, cumulative delta moving down, and, like strong selling, and price just going flat. And the guy that's only looking at the chart is just going to be like, oh, well, we're stuck in a range. I'm going to play the range and try and buy it here. And the guy coming over here and looking at the order flow is going to see, hey, even though the price isn't moving, somebody is executing a large meta order, and I think I know why. And because I know why, I know that there's a lot more orders to come, so I can take a short, right? You're getting like feedback. Maybe you already knew that was the flow and you were just kind of waiting for evidence of the flow, but it could also be like you're generally aware maybe this could be a thing, but you're not sure what's going on. And then you start to see the flow and you say, oh, it must be this thing, right? And then you can take the trade. And the person on the chart, they're not going to see that. And similarly, people on charts, they do all of these things where it's like, okay, today we moved this much, but yesterday we moved this much. So, like, we weren't able to make a new high or whatever the deal was. So that must mean that the market is getting weaker. Like the Dow theory sort of a thing, right? Well, the issue with that is that it doesn't factor in liquidity conditions. Maybe the day before was a holiday and there wasn't a lot of liquidity in the markets. And the next day was a day where there was a lot of liquidity in the markets, and so they weren't able to move as far. But there was actually way more market orders willing to go in and trade in that thing. And that kind of tells us something about the market that I think is kind of important to know about, like, at the very least, like what sentiment is, for instance, that you cannot see on a chart. So it comes back to what I was saying. Okay, like the edge comes from fundamentals. I'm being like way too broad with the things here, but for like the general audience, your edge as a day trader, the best opportunity that you have for edge as a day trader is fundamentals. But you're not going to be able to build that edge if you are not also watching the order flow. Because the order flow helps you understand what's actually happening in the market. Okay, you have the fundamentals. How did everybody react to those fundamentals? You don't get a complete understanding of that without watching the DOM. Just straight up. Well, it does look like that another large, another leg is coming in here. It's a relatively gentle shift in cumulative delta. It is accompanied by a move down in the dollar, and it is coming up into our kind of stop out zone. So I'm definitely not looking to add a trade up here on like it's going to continue through. That's probably not very realistic. Send me a message. Hi. So really what you can think of it as, because like setups don't really work, what we have to think of it in terms of predictors of order flow. Here's a piece of information. That piece of information results in a certain number of orders coming into the market, or a certain set of orders coming into the market, right? So if we were to do like a survey, we were able to find everything that predicts orders in the markets. And then we look at the magnitude of each of those things to say the magnitude of those order flows is essentially equivalent to how much edge there is in that particular predictor of order flow, right? So my theory is that if we were to categorize those things into different sections, predictors of order flow that retail day traders can use. I would say that the fundamentals basket is probably by far the largest. More orders will come into the market because of changes in fundamentals. And there is more overall inefficiency in the market because of things about inefficiencies. So as a day trader, I really do believe that there is more edge available for you in understanding the fundamentals. Fundamentals beats technicals for day traders. See, we've all been misled because all of the popular culture that we've been looking at since we've been kids, you gotta understand, I mean, it's kind of an unsavory thing to think about, but you have been influenced by the popular culture. When you talk about like so I've been watching this Strong Source podcast, and they're talking to really successful commodities traders, and almost all of them will mention movies like Trading Places and these other movies that had views of trading floors in them, right? Like the popular culture affects us and is one of the major things that drives us to want to pursue this. And over our lifetime, all of the popular culture has been primarily about technicals. Okay, like there's all these books written about the turtle traders. Okay, well, they were momentum traders. They're not day traders, but they are technical traders. So we're interested in the technicals. There's like the Flash Boys and high frequency trading and now quant trading and all of these sorts. It's all technicals, right? But they're also all games that like we as retail traders aren't really competitive in. So everything has been priming us to be technical traders. But I'm telling you that the reality is that there's more edge available for you in the fundamentals. Agreed. Could it also be said the reaction to fundamentals is potentially more impactful? Yeah. There more orders will come through on those. Yeah. Like if cumulative delta has changed 50 to 100,000 contracts throughout the day, almost certainly there was an economic report that day or really big heavy hitting, tweet from Donald Trump or something like that, right? Like probably there was fundamental catalyst for that. And all of the things that you might be looking for on that might be considered technical that could be a predictor of order flow are like super teeny tiny. Okay, will the big players most likely start a meta order with market orders? So starting it, maybe not necessarily. So my understanding of it is that they try and get as many orders filled on the limit as they can before things kind of start. But ultimately, in order to get an order like a really big order like that filled, they will have to use market orders. Like it can be at most 50% limit orders. Like if they did a really, really good job and were really lucky, they might get 50% limit orders. But that does depend on the size of it. I'm really talking about a big one. Yeah, in part, gauging the emotional response and how that will manifest is, yes, exactly. So like there's a change in the fundamentals. How many people care about that change in the fundamentals? Like what is the current sentiment at? What are the key issues that things, because I can't just say like, oh, here's how much it moved in CPI last time. This is how much it's going to move in CPI this time, because the market cares more about CPI right now. Right? And so here again, there's all of this kind of nuance that you're picking up along the way, like that those years and years of trading experience that you're picking up on, right? And you're not really getting the full picture if you're not looking at the order flow. Okay, yeah, so AO has a picture. which is pretty close to what I do. Okay, he has the offers, the bids, the market orders in between, and then this one right here looks like that is probably net stacking and pulling. Yeah. This is a volume profile. And this one looks to me like this is probably a delta difference. Like how many buys minus sells there were at that individual price, which is something I think is interesting to look at. I don't know if we have an explicit edge off of that, but okay, yeah. He has all three of them together there so that he can kind of see that this one moved more than the other. And then he does have a footprint chart, which is kind of, you know, like, I don't know if there's actually any edge in that or not, but. The turtles were trading breakouts of the 20-day high low. Yeah, but they weren't day traders. Yeah. Turtle traders were technical traders, but they weren't day traders. Nice. Oh, there we go. Gonna say I just heard a child move. Where's the other one? I think that they are have gotten past the I'm super sleepy stage and are now in search of food. Oh, but you know what? It's time for me to get going anyways. And there's the other one. Sleeping on the giant Pikachu. I'm going to try and make a TikTok about this today. Oh, the Darvis box is kind of a similar sort of a thing. But yeah. It was kind of this thing that everybody was... But I tell you what, man, I really think that the momentum traders really screwed a lot of things up. Because what they did was, you know, like there's the Jack Swagger books and all this stuff. Like they had some success and they went out and they told people about it, right? But in doing so, it really seems to me like they intentionally misled people too. Like they wanted to receive recognition for what they were doing, but they didn't want to tell you enough for other people to be able to take it, to be able to do it themselves. So like all of these books and materials that they made are all like really, really useful information if you're trading one of those strategies, if you already know the strategy, right? Like if you already have a momentum strategy built up and back tested and working, okay, then all of the things that people say about trading totally apply. The edge is primarily in the risk management of it, and it's all about the psychology of it because those strategies take really big drawdowns. And so you have to keep your wits about you and be able to still make effective decisions when the performance isn't going very well. But that was all kind of premised on the fact that they have an edge, which was that asset prices tend to trend over long periods of time, right? They had that edge to begin with, and now the whole thing is, in order to take advantage of that edge, like the risk management. So retail traders, we think risk management is, well, I need to have a stop and a target, and I need to hold to those and stick to them, right? And that's what's gonna, no, that's kind of like a necessary thing to be able to like not blow your account, but it's not going to provide an edge to you in and of itself. That's still just going to be break even. See, when the turtle traders were talking about risk management, they were talking about you have a $10 million portfolio. You're getting a signal on this one asset that says to buy. How many contracts do I use? I'm going to look at the volatility of that instrument to determine how many contracts to trade. But then I'm also going to look at the correlations between that instrument and other instruments. Because if I already have a position in something that's highly correlated, then I don't really want to take it. I don't want to add more risk to it. Maybe I want to, okay, these are correlated, but I want to have half of it in this and half of it in this, or something like that, right? And analyzing all of the relationships between these things is where the edge really comes from, is taking that signal across a wide variety of assets and then doing really sophisticated analysis about how to size them. That's where the edge came from. And that's why they tell you that the edge is all in the risk management, because for the turtle traders it was. But for you, it's not. Okay? For you, it's not. Risk management is just what keeps you alive, but it's not an edge. I should make a, because there's this thing that I really don't like, the distinction that we have between technicals and fundamentals. I think that the better framework to work from is orders are what moves the market. There are pieces of information that we can have that can predict future orders. And how it fits into whether it's fundamental or technical doesn't really matter. Like that distinction was something that I can see being useful for like stock traders doing swings, but for us it doesn't really help. But that is the popular culture, and so to come in and to tell people, well, the real issue is you're trying to do technicals. Fundamentals are more important for day traders. That maybe gets the message to people better. I may have missed this in the prior conversation, but is there like a distilled data point or points that causes you to take a trade? Well, not in that respect with to like data that we have in the computer, right? So I will have a theory about what's going to drive order flow, and that's stuff that I'm scraping myself. I really don't think that the technology is really there to the extent that would be needed to like scrape the web for the data. So, I tell you, one of the really big challenges in computer right now is like validating authority of things. You know what I mean? Like it's going to go and scrape the web and find every little teeny tiny piece of information that it possibly can. How many orders is that possibly going to drive? Well, that kind of depends on the authority of the source that you got it from, right? AI model can't really do that. I think one of the optimizations that they've made that I've kind of noticed is that in the beginning it seemed like it was mostly just data scraped from the web, and they kind of shifted to weighing higher stuff from like journal articles and stuff, the peer-reviewed articles, right? Okay, so the technology is not there, but maybe someday it will be there, and then you could say, okay, so here's the data points that makes me say there's going to be an imbalance, and then I'm kind of watching, and each little thing that happens, which way the cumulative delta is going, how the bids and offers are reacting to those orders, everything else, those are all kind of little tea leaves that, there's basically a threshold that says to me, I have enough evidence to suggest that the meta order I'm expecting is there to take a trade. So then in that respect, maybe you could say that there is. And I do think that some of the things that I'm looking for as like those confirmations in the order flow are things that can kind of be systematized. Is just, I don't think I can necessarily expect to take that one component of it and make a automated setup on it and expect it to always be profitable. But we are going to try that on Monday, I think. You know, this is a fallacy I fall into for early on too, is like, the setup doesn't happen very often, but when it does, it pays really, really well. The problem with those kinds of setups is that you don't have as big of a sample size. So those kinds of setups are actually a little bit easier to fool us because we don't realize how little data we actually have, right? Like I remember I was saying, okay, if we only get one data point every day, then in order to have 10,000 data points, we need like 40 years. Okay, now you're talking about something that doesn't even happen every day or every week. How are you going to get enough data samples to actually see the full distribution of it? You can't. But order flow is a little bit different because there's so much data that comes through that you can see quite clear aberrations in the data. They're very well proven. And, you know, I really think, like, why do we see these stylized behaviors in order flow, and there's not as much stylized behaviors in price itself? I really think it's because market makers inject that volatility into the market. They need that randomness into it. And so the noise is so much that you can't really pull those out. You can't differentiate the signal from the noise in most of those cases. And because of the nature of that noise, because that noise is such the really the dominant factor, all of the stylized behaviors that we end up being able to pull out of price itself end up having to do with volatility, right? Like the volatility clusters and all these sort of things, right? Anyways, I don't feel like that we answered the thing that we're really coming at, though, which is like, what can I possibly be doing in the next 2 months to increase the chances of this YouTube channel being successful in those 2 months? That it can help us if we're not able to find a day job. So is spending the whole stream talking about this stuff and teaching it over and over and over again, and possibly arguing with the non-believers for, you know, and getting really excited about it and trying to entertain people with the antagonism, is that really the best that I've got right now? So I kind of feel like that's not really providing value to the world, you know, even though it's fun. Andrew's pitchfork. I haven't looked at that in a long time. I don't know if there's really any academic data on that. Let's see here. Scholar.google.com. There's a book. Stock price prediction using deep learning and natural language processing. Well, this is not saying, oh, we're studying Andrew's pitchfork. They're just saying, oh, here are some things that some people will try and use in their trading, like Bollinger Bands, etc. So didn't really get the... Really wish I could see your ladders. You can't see them? I mean, if you set the stream to its highest quality and make it full screen, you should be able to read it. Look at body. Like, I'm really not interested in your theories unless you have empirical evidence with them. Right? Like if we have an established set of empirical evidence to work with, we all understand that, and then we start making theories based on that empirical evidence, right? Well, I think this. Like I said one. I think that there's more edge in fundamentals than there are technicals, if from an order flow view of the markets, right? This is a theory, but it's a theory that's based on you having enough context about the known empirical information to understand why I'm even proposing that theory, right? Then we can have interesting conversations. And like the whole point of teaching you guys this stuff is so that you can contribute in that way. Because what happens instead is everybody has their own base that comes from completely different places and are completely unsubstantiated, and you just end up talking past each other, and you're making a bunch of conjectures and things that are it's just noise. There's no way to differentiate signal from noise in that case, right? It's only once we have a unified set of empirical data to start our discussion from that we can actually have a useful discussion. So when people come into the stream and they want to talk about their theories about the market that aren't empirically backed, all I'm going to do is argue with them about, here's what the empirical data says. And if you don't have empirical data with it, then you're just wasting your breath. And frankly, I'm kind of starting to come to this point where it's like, it's not just like you're not going to win that argument. I'm wondering if it's really wasting the entire stream's time. I'm kind of wondering if it's like I spend one day talking about that, 2 days now, I guess. I mean, I think that today's conversation was useful and everything, but it wasn't like moving my understanding of the markets further, right? It wasn't resulting in a profitable trade. It was kind of like I got the profitable trade in and out of the way, and then let's talk, then let's teach, right? When what could we be doing with that time? Doing some empirical research about the behaviors of spreads. That's one that I want to do. Just writing and recording videos, maybe, I guess. It's just like a month and a half of time left to do this. Of course, then after that, there's still more time, but then I'm really kind of very unhappy at that point. But life goes on after that, right? It's not like a drop dead date, but we kind of want, if the YouTube channel is gonna like explode and do really well, and people are gonna, the YouTube channel gets the attention that it deserves, I think. It needs to happen in the next month, guys. It really does. It's not like it will never happen, but like I need to do everything that I possibly can within reason to make it happen in the next month. And I kind of feel like that arguing with people is not getting us there, let's not debate. Let's just test out these concepts and results. Well, but I mean, that's the other thing, Chad, right? Is that there's like a billion different technical analysis day trading setups that I can backtest, right? I kind of feel like that's a waste of time too. Like, because if my overall theory is that like you're just not really going to find a real profitable strategy using that information, then it's kind of pointless anyways, right? Now, doing the backtesting on my order flow indicators, that's different, because now that's research that people haven't really been able to do previously. People at quant firms have, but retail traders haven't. And so that's really cool, right? How using research to understand things about the market that we don't understand well enough yet, like the behaviors of spreads. There's some value to glean in that. But then the issue of that is does that really actually move the needle, right? Like, I can go and I can do that. Oh, okay, now we know something about spreads. Okay, but who watches that? Does that make the channel blow up? It doesn't, right? It doesn't move the needle. So it's got to be either like that thing, it ends up being the thing that like I find there's so much edge in it that I can like just confidently start trading from it and making a living from it. Highly unlikely to happen, right? Or there's something about it that garners enough interest to boost the channel to where it needs to go, The bottom DOMs are so thin, why bother? Well, because I take the trades in the 10-year. I don't know if there's a lot of value in having these other ones up, but like, what else? What am I going to do? It's just, at some point, I do want to take and manage spread trades between the 2 and the 10. We'd have to do some work here. We have to do some work here on that one to bring the spread in. One of the things that I'm interested in is creating market maker robot that market makes in the 2-year. How do I determine? Like, there's a lot of room there, right? So how do I determine what I want to do with my bids and offers when I can be the best bid and best offer? And I'm going to be the one that's going to get filled if anybody decides to take a trade in the 2-year today. Well, I think that the best way to do it would be to look at broker tech and see what the bid and offer on the yields was over there and base it all off of that, right? But I don't get that data, so I don't know what to do. There's got to be some way. Well, I was thinking about that the other day because I remember somebody was saying like, it seems to me like that, there's always some way to approximate it that's good enough. Okay, approximate the 2-year yield. You can find something that approximates the 2-year yield, we could probably do something super cool with it. But I haven't really been able to find something that I can like, that's like fully automated that I really think is effective at doing that. Your old setup with the naked chart? Yeah, because those charts were useless. That's why. And because I wanted to see more room. I wanted to have more room to make these bigger and see what... Yeah. I think a YouTube stream does need to provide a little bit of entertainment for it to grow. Talking about order flow 24/7. Well, yeah, that's true. And like, I don't think that arguing about order flow provides that entertainment either. You're right. It's kind of like, the entertainment that people want is you taking a big position and holding it, right? Or a big loss. I mean, the biggest losing days do tend to be the most watched ones. I haven't had really big losing days in a while. But I can remember pre-COVID, the days where I was doing the worst tended to be the most watched. I think maybe because people were like, oh, Seth's doing really bad, and they passed the link around or something like that. I don't know. How do we do today, by the way? Because, yeah. I'm going to say maybe not quite as well as yesterday, but within the bounds of, you know, margin of error. 1 or 2 viewers difference. And that's in a day where the past hour I'd been gone, right? So it might be because of that. The only thing I can ask of you guys is put out videos. I should be putting out a video on Monday. I haven't heard from my video editor, but we're supposed to be putting it out on Monday. If it's not Monday, then I will just finish editing myself and put out what I got. But when you see those videos, watch them. Watch the whole thing. Maybe watch it twice. Like the video. Copy it and send it to your friends. Mention it on Reddit, I guess. I don't know, like whatever we can do, because we just whatever we can do to get this thing to take off in the next month. We got to try and make it happen. It used to be, well, I don't really want it to be popular. Don't talk about the stream. And you know, I still like that way of doing it, but just don't have that luxury right now. Like, the best case scenario would be that in the next month the YouTube channel pops off. So whatever you can think of to help make it happen. I don't know if putting charts on the top of these things though, like again, from what I see in the metrics that I get and everything, the issue is more that YouTube doesn't show the stream to enough people because there's not a strong enough click-through rate. So it has more to do with the thumbnail. So can change the thumbnail. I guess that isn't good enough. Change that. But I don't know if that's really, if you really can make a game-changing enough change in that to fix that problem. I don't know. See you guys Monday. Stay